Hey everybody, Chris Englebert with the Englebert Angle for this week. And I'd again like to thank everybody at QDEC for helping to put this episode together. You can see by my headline, I am talking about something that's obviously been going on right now: emotional investing, panic, and fear. So what's going to happen in a couple of weeks is people are going to be getting their statements for the month of June. And what they're going to be seeing is that they're going to be seeing that the stock market has not been a fun place to be. Right now, if the stock market closed at these particular levels, it would be the fourth worst start in the history of the stock market ever. So you can see by the numbers, Dow Jones is down almost 16% year to date, S&P down almost 20%, NASDAQ down 28.6% year to date. But wait, what's really a problem out there is that the bond market has declined sharply as well as interest rates have risen. And so one of the things that we do is that as an investment advisor, we're trying to create a situation where we can control volatility by using bonds, because obviously bonds produce income. Well, what happened this year is that the panic going on as far as inflationary pressures have caused interest rates to rise sharply and bonds to fall. Now, does that mean that you should get rid of your bond investments? Absolutely not. And we're going to talk more about that in a minute. But we just want everybody to remember that when you're looking at the investment markets, you've got to realize that they are not linear, that they don't go down in a straight line. Now, sometimes it feels like they are, because obviously the equity markets had a bad month of April, a little bit of a rally in May, and then a bad month in June. So it feels like if you are looking at your portfolio on an hourly, daily, weekly basis, it's going down, down, down. Again, you probably shouldn't look at your portfolio every day. Check in with your financial advisor, have a meeting with them and talk about it. But again, markets are not linear. Just because something went down last week doesn't mean it's going to go down next week as well. So the markets move up and down all the time. We see that literally we're having 2, 3, 4% moves in a day, and people get obviously upset by that volatility. But the one thing that we really want to focus on, and we focus on it with our clients, is how much everybody has in their particular risk bucket. So when we run an account here at Englebert Financial Advisors, let's say you have a $300,000 IRA. We might have, depending upon your age, $100,000 in a very safe risk buckets. Bank CDs, short-term bonds, things that investments that don't really move around a lot in price, because obviously that's your safe bucket. We then might have investments in the medium-term bucket, like utility stocks, dividend payers, which obviously are going to go up and down more, but not as up and down as much as what the regular stock market does. Example, S&P 500 or the NASDAQ. Then you may have a third bucket, which is a much more aggressive bucket, which if the market's down 20%, that bucket might be down 20%. So again, what you have in each bucket is very important, because when we run an account for you, we don't have, depending upon your age, all of your money in a high risk bucket, unless you happen to have a lot of years before retirement and you can stand that risk. And maybe you have a defined benefit pension plan or something else in another particular asset class that's offsetting the risk as far as that goes. So how much should you have in each bucket? You got to talk to your financial advisor about that. But if you look at your account, many times people forget that, hey, I've got different risk buckets in one particular account, and that those risk buckets are acting differently depending upon when the markets are going up and down. So the other thing is, be prepared to sell what's not working. What I always tell people is that when a market's going down, it's very difficult to figure out, hey, what's working, what's not working. But what we watch for is on any market rebound, what's not working out there. Is there a particular stock that's not participating in the market rebound? Is there something going on with that? Is there a particular fixed income investment that really doesn't fit into your strategy anymore? Maybe we shift that money and move it to someplace else. But the problem that I have, and one of the things that people talk to me all about all the time, is they say, well, why don't we just sell everything right now and then put the money back in when everything looks better? You can't do that. You got to have a game plan, because what we've seen is that after many of the worst market days, weeks or months, we then have some of the best market days, weeks or months. So to try to sell out and get back in is a losing proposition and very difficult to do. What we do in our practice is we dial up and down the risk parameters as far as our clients' investments go. So at the beginning of the year, we were playing defense. Could we have played a lot more defense? Absolutely. But in the last several months, April, May, and June, we've been playing a lot more offense, and putting money to work in the equity market. So what's your game plan? One of the things that we are trying to tell clients right now is the stock market is already pricing in a moderate to a severe recession. If you watch the news, which we don't suggest to do, you're hearing a lot of the market pundits out there saying, we've got to go into a recession. We have to have a recession. We're going to go into a recession. So what happens, we ask, if we don't go into a recession? We believe the surprise could be on the upside. Now, the other thing that we're trying to train people to do is to buy when things are down. The investment markets are the only place I know that, unlike TJ Maxx, where everybody flocks to a sale, the stock market goes down 20%, people want to sell, they don't want to buy. Stock market goes up 20%, people want to buy, they don't want to sell. So one of the things that we try to train our clients to do is that if the market continues down, how much money do you want to put to work? 5% lower, 10% lower, 15% lower. You need to kind of set targets and say, okay, the market's down 20% and it goes down another 5%, I'm going to put X dollars to work. If it goes down 10%, I'm going to put X more dollars to work. That's the winning strategy in the long run. The other thing that's going to happen out there is do you want to do some tax loss selling? So what ends up happening is, if it's a taxable account, you may have long-term capital gains in your account that if you sold those particular positions, you would take a huge tax hit. Well, if you already have some losses so far this year, you may be able to sell some other investments to take a loss to offset any capital gains that you may have realized for the year. I think this fall you're going to see a lot of capital gains and tax loss selling going on, because obviously the first 6 months of the year, both bonds and stocks are down. So the other thing that you can do is, instead of waiting until the end of the year to make your contributions, if you have an IRA or a SEP IRA, or if you have a one-person 401k, what you can do is you can make those contributions now and get that money to work. So we believe that we're at the ultimate fear and panic mode right now in the investment markets. We don't believe that we're going to go into a moderate or a severe recession. So we're looking for the surprise on the upside. We think interest rates have peaked for the year. We think interest rates are going to moderate. We think inflation has peaked as well. And we think inflation is going to moderate in the coming months. And we're looking for the back half of the year to be much better than obviously the first half of the year. That's all we have for this week. We'll be back next week. We'll talk to you soon.